NextEnergy Solar Fund is a solar infrastructure-focused investment trust, which is one of the leading investors in the UK solar market and battery storage business, both of which are set to be crucially important through to the race to net zero and climate targets. Ross Greer, who sits on the investment committee of NextEnergy Solar Fund, joins us now with some more on this. It's an interesting area of the market. And I know you've just had a significant milestone recently, which I'd like to touch on in just a moment's time. But let's start it off by addressing some people's attitude towards this is that we just don't have enough sun in this country. Renewables are not an answer to our demands for what is a heavy demand on the grid for electricity.
Sure.
What do you say to those that are sceptics?
So I think I've been in this business now at NextEnergy for 10 years. So I'm very used to that particular challenge. I feel like we've actually kind of moved past it in the majority of investors' minds, given what we've done over the last decade. But really, solar has demonstrated itself as a super reliable, from a technology perspective, technology class, as an infra investment, reliable, predictable cash flows, and an important part of how we drive green energy into the grid. I think the decarbonisation argument is clear from everyone's perspective, and solar definitely globally contributes in a big way to delivering those targets. Solar is one of the fastest forms of technology to implement. So from concept through to energization, it can be as quick as 18, 24 months, which in the context of something like nuclear, for example, shows how quickly we can make a meaningful impact on those net zero targets through the deployment of solar and things like onshore wind as well. Solar in the UK is super viable. We've demonstrated that through the NextEnergy Solar Fund platform. We've year on year achieved our targets in terms of generation expectations. And really, solar is quite a simple economics argument. So what you really are looking at is the cost of the equipment and the amount of sunlight that you reliably achieve on a year by year basis in a specific location. So very predictable, very reliable. The cost of solar has come down materially over the last decade and continues to trend in the right direction to allow us to continue to deliver more solar onto the grid. So we've got about 16 gigawatts of solar in the UK from a standing start around about a decade ago. And we're shooting for around 70 gigawatts by 2035 in line with the government's decarbonisation ambitions.
And of course, interesting, isn't it, that technology is improving as well. Not only is the cost coming down from a personal point of view, someone that wants to install solar, it is now becoming more economically viable. The payback period is a lot shorter than, of course, it was. Definitely. What about the battery technology, though? Is that up to speed yet, do you think, to be commercially viable? The economics there is as persuasive?
So definitely is as well. Battery is slightly earlier on in its journey than solar is. We've really only been thinking utility scale battery storage for the last kind of 2, 3, 4 years as a kind of infrastructure investment. Before that, it's very much a PE investment. What we're seeing there is technology improve materially. So we're seeing costs come down. We're seeing power density increase materially. So a shipping container now has twice the amount of power output that it had 18, 24 months ago. And that trend is important as we look to continue to drive more battery storage into the grid. From a technology perspective, really these things are giant iPhone batteries. So they are, the same sort of technology we use in our daily life. So there's nothing super creative about what they do or how we use them. The monetization is slightly more complex than traditional renewables. So what we're doing in those markets is providing some grid stability services to ensure the lights stay on. But we're also using the battery for arbitrage as well. So we're buying power when it's cheap and we're selling it when it's expensive in order to, again, just create that consistent level playing field from a generation perspective as well. Because obviously, as we increase the amount of renewables on the grid, they are more volatile due to the very nature of the source of that energy. So a very important component of net zero, slightly earlier on in its journey. We're super excited to have energized our first kind of maiden battery storage asset, which we'll talk a little bit more about in later on in this session, as part of continued evolution of the NextEnergy Solar platform and as it continues to drive towards that net zero goal.
Well, let's pick up on that point and then talk about this milestone, as I said, and I believe you've called the Project Camilla.
Correct, yeah.
For whatever reason. Good name. What's happening there? Tell us a bit more about that and what the project is going to give investors into the fund.
So the two milestones that we've hit are we've achieved 1 gigawatt of operating capacity which is a significant milestone. We're the first of the solar-focused listed peers to achieve that milestone. And at the same time, we've also energized, as we've said, this Camilla battery storage asset. That is a 50 megawatt standalone battery. So it's a very large scale utility asset. It's based in Fife in Scotland, and it's currently energized at a 1 hour duration, but will be advanced to 2 hour duration in due course. Quite
what's
technical.
That mean exactly?
What it allows us to do is to generate peak output for an amount of time. So the 1 hour duration period allows us to do a certain amount of services, a certain amount of arbitrage. A longer duration battery is now the right setup for us to maximize revenue generation for that particular asset. Why it's important to us is we believe in that evolution of the platform as we drive towards a future energy market that is more flexible, is more based on renewables than historically it has been. As power remains more volatile due to the kind of energy generation sources that we're using, battery becomes increasingly important. So what we'll see is a nice combination of very short batteries providing some super fast grid support services. Then we'll see some medium terms, 2 to 4 hour duration batteries doing lots of arbitrage, so intraday movements of power to ensure that everyone, again, can continue to access power at the right price point and when they need it. And then we'll see longer seasonal duration batteries come into the mix as well. So we can start to really shape shift those renewable technology sets to provide baseload in due course. And energy mix is, of course, really important. So, I'm not saying solar is the answer to everything, but solar plus battery or wind plus battery does a really good job of generating baseload, which is what we're really seeking to do to bring stability to price and security of energy to the consumer.
Why Fife? Is it significant that it's there particularly?
It is, yeah. So what we see is the importance of geographic location in the siting of batteries. We've got two in the portfolio, one that's constructed, one that is in development at the moment, or rather one that is in pre-construction preparation at the moment. They're both strategically located in high areas of congestion. So in Fife, we see lots of onshore wind that is curtailed and is struggling to push its power out into the grid. Therefore, there is lots of opportunity for us to really do that arbitrage, to relieve that pressure on the grid alongside other batteries, and to continue to allow those green electrons to flow into the grid and help us decarbonise.
What about areas where maybe it's not quite so economically viable? What do you do? How do you spread this out? Is it a blueprint for other areas, or do you have to change the development of the projects in different areas depending on the demand and supply?
So a combination of factors drive it. I think battery storage is a slightly easier development journey due to its compressed footprint than a traditional renewables generator. So, solar these days is relatively large in scale. In terms of ground footprint, batteries are much smaller, and therefore we are seeing a big uptick across the country in terms of battery development. Really, what is driving development in specific locations is availability of grid. So where you're able to secure an import and an export, so crucially you need both import and export in battery. At scale is where you're finding batteries are sited, but in terms of the pipelines that we see, it is pretty geographically diverse. We're also seeing the government consider energy market evolution, so a thing called REMA, Review of the Energy Markets. That's starting to think about driving investment signals into new infrastructure. So it's starting to think more locationally about how people pay for their energy, or what your cost of energy is based on the constraints that are in your particular area at any one time. Lots of complexity to unpack in that space, and doesn't have an impact really on today's investment decisions, other than we're obviously thoughtful about those areas where there is congestion, because that's always where that type of technology is going to be needed.
What about the relationship between renewables and the government? Do you get frustrated sometimes at what's happening with government? Government dynamics are very different to the needs and wants of people. Sure. And renewables and so forth. The government seems to be flip-flopping around this idea about whether or not it wants to go for the targets that have been set out. How does that impact on your decision to invest?
So I think we've been successful to date, kind of despite government policy and despite government, short-term decision-making or electioneering, which we've seen a lot of over the last decade. We're seeing a lot of in the current year. the investment case speaks for itself these days in terms of it making more sense to deliver a solar asset than it does to deliver a new nuclear or other kind of more traditional generating facility. So that does help us to continue to steady the ship and drive capital into the space. The most important thing from my perspective as we think about those future targets is making sure the UK remains an attractive place for infrastructure investments. Now, we do a good job of ensuring the regulatory environment is strong. We do very little on a retrospective basis to undermine those business cases. That does help us to kind of drive those capital flows in, but that capital is transient in nature as well. So it's always looking for where it can deploy at maximum scale. And some of the challenges, I sit in the government solar task force, some of the challenges we've been discussing in achieving those 70 gigawatts by 2035 is all about how we can continue to kind of maintain optimal economic conditions. So how can we get projects through the grid connection process in a timely manner, ensure the planning system works to support the continued rollout of projects so we can continue to show that pipeline to investors and therefore drive capital into this space as well. We still think the UK is a great environment for investing in solar and battery storage assets particularly. We've got a really strong pipeline in the NextEnergy Solar Fund itself, and we see attractive opportunities today and into the future as well as we continue to see other aspects of society really drive for electrification and decarbonisation.
Just very briefly, that task force, is that dictated by the government of the day? In other words, if we do get a change of government later in the year, is it all going to change? Are you going to have a different dynamic to that, or is it beyond government?
It's a joint government and Solar Energy UK, the industry's working body. So the principles there are really what we're working through at the moment is to draft a roadmap that shows that kind of transition out to 70 gigawatts by 2035, and to put in place the actions that are required both on a government and also industry side as well. So it will bypass whatever government happens to be in power in due course. Obviously, we're seeing various different governments talk to that green agenda in very different ways for the foreseeable future. So what we've done as an industry is come together for the very first time and put this marker down to say this is the potential of the industry out to 2035. These are the types of things that we need to see from both the industry and government to achieve that ambitious goal.
Right. Let me just quickly go back to what we were talking about Camilla. My understanding is it's the first asset to be delivered through the company's £300 million joint venture.
Correct,
with Eel Power Limited.
Yes.
These joint ventures, what's this one? What was this one put together for particularly?
So the NextEnergy Solar Fund has been a really solar-focused investment vehicle for the last 10 years. What we wanted to do for investors was to bring an absolute expert into that mix to help us monetize the asset long-term. So the joint venture was designed to bring Eel Power, one of the sector-leading battery operators, to just help us on that journey. So really proud to bring the battery online in that joint venture. That allows us and Eel to work in partnership over the long term to ensure we're looking after the asset's health and that we're extracting maximum value from it over the long term, and that we're also considering the likely revenues in the right way in the mix of the portfolio as we look at things like dividend cover expectations for the foreseeable future for the platform.
Let's look at the share price of the NextEnergy Solar Fund, the trust that is listed on the London markets. Look, we're talking to a lot of companies and a lot of trusts with the same sort of directional travel. There's been a sell-off in many areas where people don't really understand what's going on. What can you say about this? You're trading at a discount to NAV. What is the discount?
It's about 30% at the moment.
Okay, fine. So what would you say to anybody looking at this, thinking about this as an opportunity to invest, but is this a good moment? What's the future looking like, and what's going to stir recovery in this?
I think all fantastic questions. So the fundamentals from my perspective are that the underlying asset base in this portfolio, so 103 operating utility scale assets, is super robust. So they've year on year been performing in line with expectations.
Very defensive in its...
Yeah, exactly. Yeah. The revenues have been as we've expected them to be. Operational cost has been as we've expected it to be. So it's super predictable in the way it has been performing. Also, the way that we generate the net asset value, you can criticise NAVs all day long, but as a tool for understanding what this thing is worth as a fund, we believe, using external data points only and using our auditors to crawl through that NAV, we are comfortable that NAV is a good representation of what these things are worth in the marketplace. All of that is grand, right? I think what we're seeing in the market is a discount across the sector, not only in renewables or the alternative space, but also in the real estate space as well. And a whole load of market sentiment shift needs to happen in order to kind of re-energize those sectors. But as a business, we've been doing what we think is right in terms of considering total shareholder return in our actions to try and narrow that discount over time, and also to prepare the platform for the exciting growth that it inevitably has in the future. So we've been looking at a capital recycling program. We identified 235 megawatts of solar that we've been taking through a comprehensive sale process. We've sold the first phase of that, which was a 60 megawatts asset that delivered 2 times MOIC, so very attractive returns. That was to a related party, so market wants an external data point. Can't say a lot more because of the listed nature of the trust around the second and third phases of that transaction, but it is ongoing, and critically from my perspective, it's been competitive, and competitive in the context of the kind of NAV that we have in place. We've then also been very clear that we are going to be extremely disciplined in the reallocation of the capital and the proceeds from those sales activities. So primarily or initially, we will downpay our revolving credit facility. So 2/3 of our debt is long-term interest rate hedged. A third of it is revolving credit facility, so is subject to those higher interest rate environments that we see at the moment. It's not really an issue for the platform because of those underlying assets that continue to generate revenue, as we've said. But it's a minor pain point, and we would like to see leverage come down a tiny bit. So we will definitely use those initial proceeds to do that. And then in partnership with the board, we've also signalled our intent to consider things like share buybacks in order to really kind of pump prime the trust again for its future growth prospects. Alongside that, we've been building the future pipeline as well, because we want to see this thing continue to grow. A couple of painful years in a 10-year history is not the end of the world. This is a super long-term platform, and because the fundamentals are so strong, actually a 30% discount presents a really attractive entry points for investors, and this sits really nicely in people's SIPs and ISAs.
Just to clarify, you're a growth stock rather than a yield stock, are you? So you're not paying a regular dividend.
Predominantly yield. We pay a very consistent dividend. Current dividend target is 8.35 pence. Divi yield's about 10 to 12%. We're one of the leading payers of dividend in the market. Divi for this financial year is 1.3 times cash covered, and historically we've achieved or beaten RPI in the escalation of that dividend as well. So again, it talks to how strong those fundamental underlying assets are in that portfolio.
So here we are now talking just about the end of the first quarter. Give us some exciting developments you're expecting as the lead manager here at the fund.
So, we're super excited about what we've just publicised in terms of hitting that gigawatt milestone. That's a really material step forward. We continue to see attractive opportunities for future growth and have those within the fund. We're in the process of refinancing our revolving credit facilities. So, expect to hear from us in relatively short order in that regard. But from our perspective, again, limited on what I can say because of the listed nature of the fund. But we have seen a very attractive debt market that continues to allow us that liquidity in debt as well, which speaks again strongly for how, or speaks well to how strong the fundamentals of the fund are as well. And as we continue to see through this year, we will be announcing proceeds of the revolving credit facility. We'll be looking at how we reallocate that in a disciplined fashion into the future growth story of the NextEnergy Solar Fund. We are very passionate about the UK market. We're very passionate about renewables. We see lots of opportunities to continue to drive growth in not only NextEnergy Solar Fund, but also in the wider renewables market over the next decade and beyond. There's a mountain of opportunity for us to still deliver through things like this listed trust.
We talked to a lot of companies in this area, and it does sound a very exciting place to be.
It definitely is, yeah.
And making sure people understand the long-term benefits. Ross, look, thanks indeed for your time. It's been a pleasure catching up with you. That's Ross Greer. He sits on the investment committee at the NextEnergy Solar Fund.